Thank you, Fiona, and good morning, everyone. Thank you for joining us today in this budget briefing session. My name is Qazi, Haque, and I'll start by briefly discussing the current economic conditions to highlight the economic environment in which this budget sits. Global inflation has moderated from its peak, but the progress to its central bank's targets has been uneven. Much of the easing in inflation in advanced economies has been due to lower goods inflation, but services inflation still remains high. Economic activity remains soft in many advanced economies amid pressures from high inflation, high interest rates, and tight financial conditions. However, global growth has been more resilient than expected, although the Chinese economy remains affected by the downturn in the property sector. In Australia, tighter monetary policy has contributed to a slowing in demand. Household spending growth has been weak, although this has been partly offset by growth in business investment and public sector spending. Inflation has moderated from its peak in 2022, driven mainly by the decline in goods inflation. But again, services inflation remains high, as in many advanced economies, and is falling more gradually now than expected earlier. Against this backdrop, this year's budget comes at a time when Australia continues to face a challenging economic environment in an uncertain global economy. The budget this year features several initiatives ranging from cost of living reliefs, including changes made to the Stage 3 tax cut, to industrial policy initiatives to promote advanced manufacturing, among other policy initiatives that I have listed here, which my colleagues will discuss further shortly. In terms of the budget bottom line, the government has managed to deliver a second consecutive surplus this fiscal year, thanks to the windfall revenue from higher commodity prices and a tight labour market. However, the budget projects higher deficits in the forward years as the government shifts its focus away from fighting inflation to promoting growth in the future years. Related to this point, a substantial challenge for medium to long-term fiscal sustainability is that the revenue boost from higher commodity prices and a tight labour market is expected to fade going forward, while at the same time, higher interest costs on debt and cost pressures associated with delivering essential services and the net zero transition will grow over time. And this will put pressure on the budget in future years and also Australia's public debt. In terms of the economic outlook, growth in Australia's major trading partners is expected to remain subdued in the near term. In China, the outlook has improved following confirmation of policy measures to support infrastructure investment by the Chinese authorities, although growth is still expected to slow down in China. Economic growth in Australia is expected to be slow over the next few years, as high inflation and earlier increases in interest rates continue to weigh on demand, with the Treasury now downgrading its forecasts, growth forecasts that is, in the forward estimates relative to the mid-year update, as you can see on the slide up there. As inflation moderates further in later years and real incomes start to rise, consumption growth is expected to pick up and drive a gradual increase in GDP growth toward the later part of the forward estimates. Inflation is expected to decline further to be within the target range, perhaps even by the end of this year, according to the budget estimates, which is more optimistic than the RBA's predictions. This decline is based on cost of living relief measures that directly reduce headline inflation and on the expectation that the labour market conditions will ease further going forward and subdued economic growth will balance demand and supply of goods and services. Overall, there are significant risks to the outlook. In terms of the global economy, geopolitical tensions, including conflict in the Middle East, could lead to more global supply shocks. Along with sticky services inflation, this may lead to higher global inflation tighter monetary policy, and softer global growth. Moreover, economic growth in China could be slower than expected, which could weigh on Australian commodity exports and pose fiscal challenges in the coming years. For the domestic economy, the current slowdown in consumption growth could persist longer, especially if cost of living pressures persist and interest rates remain higher for longer. In addition, international demand for Australian goods and services could be weaker than expected, especially if China's growth turns out to be slower. Taken together, these factors will lead to subdued economic growth in the medium term, but it will also lead to a faster return of inflation to the target. On the other hand, the upside risk to the economy is that inflation turns out to be more persistent than expected, especially if productivity growth turns out to be slower. Also, there is the risk that the cost of living measures and the additional government spending in the budget forward estimates could add to the aggregate demand in the economy and result in higher inflation, and in turn derail the narrow path that the RBA is hoping to chart to bring inflation down. I'll now pass on to my colleagues to discuss more about specific parts of the budget, starting with Associate Professor Jim Hancock. Thank you.